where there's one investment of 21.4 crore in IIFL FinTech Fund and another investment in IIFL Home Finance of worth 161 crore rupees. However, the company clarified that even if it has to take any impact of this, it is adequately capitalized to take that hit, because the impact on CRR even then would be marginal at 1.16% level. And Smriti, you're absolutely right. The company's financials in the first half of FY24 also show that picture to us. We can have the financials on our screen as well, and we can see that the PAT was up about 27% year on year in the first half of FY24. So was the net interest income. So IIFL Finance, that's the latest update we have. As and when we know more on this block deal, we'll come back to you.
Well, the stock is about 4% down in trade, but thank you for that, Pragati. Now, the government has set a deadline of May 2032 to raise public shareholding in LIC. It's actually a huge relief because it's a 10-year extension which the insurer has got, and it's the nation's largest life insurer. The public shareholding stands at 3.5%, which by the rule needs to be raised to 25%. In such a scenario, what can the government do to pare its stake in the life insurer? We have Vishwanath Nair joining us with more details.
As we know, the government has given time till May 2032 for LIC to reduce the promoter shareholding stake so that it could meet the minimum public shareholding guidelines that SEBI has. Now, remember that this was to be achieved by 2024. So now this extension comes in, which gives the company as well as the government more time to achieve this. Essentially, the government has to offload about 21.5% stake, depending on the current shareholding structure. What SEBI allows companies like this to do is you could go through an OFS route, you could go for QIPs, ETFs as well as employee shares to reduce the stake. Typically, companies go with one of these multiple means available. Most people have not done a mix of various routes to reduce promoter shareholding and increase public shareholding. In the LIC case specifically, the government is likely to go for the OFS route. But if they do that, then there's a problem, because it's 21.5% and over a 10-year period, that would be roughly about 2% every year. LIC's current market cap is in excess of 5 lakh crore. So that would mean that over 1 lakh crore rupees worth of shares will be floating around in the market if the government does go for OFS, which will, of course, end up depressing value. The current free float is quite thin. The share price, LIC, while it has gone up over the last few months, we are still far behind the IPO price of about 949 rupees per share. So that's going to be an issue that the government will have to deal with and will have to consider while they go ahead with this kind of a share sale. Now, remember that the government itself does have the power to change the timeline as much as it wants to, because currently in a public sector entity, the government can decide whether it wants to achieve the minimum public shareholding or not. That's a call that the government can take, and by the end of this 2032 period, it could very well be that the government takes more time to achieve the MPS requirements.
All right, thanks Vishy for that. LIC shares are seeing an uptrend today. But other than that, GMR Airports infrastructure is also up about 2.5% today. This comes after the National Investment and Infrastructure Fund said that it'll invest 675 crore in the company's upcoming Greenfield Airport at Bhogapuram, Andhra Pradesh. My colleague Anushi Vakharia joins in to give us GMR Airports project investment details.
Hi, well, the stock is quite in focus today. Just to get into the investment details, this will take place through its SPV, that is the Special Purpose Vehicle GMR Visakhapatnam, to develop and operate the Bhogapuram International Airport, which is projected to be one of the biggest airports in Andhra Pradesh. Now, this marks National Investment and Infrastructure's second project of the 3 projects it had declared in this 2022. Now, with this current commitment, with the current commitment and execution of the phase 1, it is estimated that the company will add about 6 million passengers per annum, and taking the total capacity to about 40 million passengers per annum eventually. Now, GMR has been quite a focal point if you look at the past month, with the recent one being the fundraising of about 3,200 crore from the 5 banks and other financial institutions to raise 3,200 crores again for the phase 1 development. Other than that, the company also had 2 large trades happening wherein GQG Partners had moved in about 4.7% equity stake of the company. So quite a buzz for this company for this month itself.
All right, thank you for that, Anushi. GMR up in trade about 3%. Now, let's move on to the hospitality sector. My colleague Hiral Dadia spoke to Mahindra Holidays MD and CEO Kavinder Singh discussing the company's capex plans going forward. Listen in.
The capital expenditure plans are already in place. We have about 835 crores of capex in play to deliver 690 rooms in the next 1 to 2 years. If I were to look at the movement forward, we are aiming to take this 835 crore number to about approximately 2,000 crore as we move into the next year. Our aim would be to very, very quickly step up our run rate of room additions, which is roughly 375 to 400. Next year, you will see much higher run rate than this number. And as far as capital expenditure plans are concerned, I already outlined that we have, at this moment of time, 2 greenfield projects that are underway. One in Ratnagiri, another is in Thiok. One is in Maharashtra, and other one is in Himachal. And we have an expansion project going on in Himachal. And then we have a few other projects which are going to be lined up for breaking the ground soon.
All right, that was Mahindra Holidays MD and CEO Kavinder Singh. But moving on to the diagnostic segment that has been in focus, we recently spoke to Rahul Guha, MD and CEO of Thyrocare, earlier today, and he expects a price hike in 2024 to be between 3 to 5%. Listen in to the slice of that conversation.
Almost all our reagents are imported into the country, so we always get affected by the dollar. So I think to compensate that, normal price increases, I would say, would be on the cards. But I think 2023 was a special year because in the previous year there was so much price competition and people, really brought prices down and made it difficult for people to, normalize their pricing structure. I think 2023 was the year where everyone came back to a more rational business operating mindset, and so therefore prices came in line with the cost structures. I think 2024 will be like a regular year in the past, where effectively to compensate for your increases in costs, largely because reagents are primarily imported. So I would expect a normal price year as we go into 2024.
All right, we'll take a very short break, but on the other side, we have a special conversation coming up. Remember, Prime Minister Modi has given a rare interview to the Financial Times where he's talked about how India is on the cusp of a takeoff. What exactly does that mean? What is the takeoff that Indians can expect? I will be joined by Madan Sabnavis and Madhvi Arora for a chat on the country's economic scenario in the wake of those comments. After a very short break, stay tuned. welcome back. Now, India is on the cusp of a takeoff. This is the key message coming in from Prime Minister Narendra Modi in a rare interview to the Financial Times. The PM has said that the people of India have very different aspirations from the ones they had 10 years ago and realize our nation is on the cusp of a takeoff. He goes on to say that people want this flight to be expedited and the best party is the one which has brought them so far. The comments come soon after a big win for the ruling BJP in the recently concluded state elections and ahead of general elections in May next year. The comments are also an important message for investors, both global and domestic, who are betting big on India as the fastest growing economy in the world. But when we talk of the nation being on the cusp of a takeoff, what does it actually mean? To speak on this, I'm joined by Madan Sabnavis, Chief Economist of the Bank of Baroda, and Madhvi Arora, also joining us on the show from MK Global. Welcome to both of you, and thank you so much for speaking with us today on NDTV Profit. Let me begin, Madan, with your take and some of those comments made in the Financial Times interview. It segues in very well with the conversation and the chatter around India. And we talk about it day in and day out from the market's perspective, from the perspective of foreign funds coming into India, etc. But on the basis of economic outlook, and look at the Q2 GDP numbers, look at the RBI's, upping the estimate, do you think we are really on the cusp of a takeoff?
No, I think that's absolutely right, Tamanna, that we are on the cusp of a takeoff. The reason being that if you look at this solitary indicator, which is probably the best indicator of prospects of any particular economy, for the last 2 years, we have seen that the Indian economy has been the best performing one, growing in this region of, say, 6.5% or 7%. Now, that is one part of it. The second thing is that we are very much on the stage which has been set for us to grow at a higher rate in the coming years. Now, if you look at the way in which most countries went post-COVID, you actually went down sharply and countries are still struggling to get up. So we're talking in terms of kind of a stagnation in the global economy, in most of the larger economies, and probably something which it didn't turn out to be as bad as what was expected. But we are generally thinking that 2024 will be a slow year for the world economy because of what the central banks have done. However, if you look at India, I think even though we are going to register a growth rate close to 7%, that's what the RBI is saying for this financial year, I think the growth is going to continue on this particular path. So that's why we are saying that on the cusp, we're just on the border of a takeoff. So I think all the prerequisites which are required for growth are very much in place. And in case we do have a good monsoon, I'm quite sure that we could replicate this growth of again 7% for next year. So what this really means for foreign investors is there's a big opportunity. I don't think there are any minuses which I can see right now. Policy framework is very good. What RBI is doing, what the government is doing on the fiscal side. So all we are waiting is for this push to come on both consumption and investment. So therefore, to say that we are on the cusp of a takeoff is probably the right way of looking at the Indian economy.
All right. What does that takeoff actually mean and what will it look like is the question. Let me go across to Madhvi Arora on that point. So India is a story that has been celebrated for a while. But whenever we talk about quote unquote a takeoff or, being the fifth largest economy or reaching the $5 trillion mark, the question also comes about, is everyone growing equally? Is your per capita income moving up? Is your rural consumption going up? Now, talk about that, Madhvi, and what would truly in India look like if it took off in the way that is being envisioned?
So you're talking about the development sector of the economy. Clearly, there's a long way to go with regard to us matching the likes of China in terms of per capita. But definitely the socio-economic color of the economy, has been changing, especially for the rural and semi-rural sectors. I mean, look at the way the subsidy targeting has been done by the government of India. Even though the government has reduced subsidy burden, but the kind of targeting they have done has essentially implied that there's been a general upliftment of the bottom of the pyramid. So there's not necessarily as much dissatisfaction in the lower economic strata as it used to be at one point in time. So I think to that extent, there's obviously an improvement. It's a very long way to go. That said, on a more broad growth point of view, of course, as you mentioned early, Parth, there's been a lot of supply side measures that the government of India has done over the last few years. And of course, the kind of reforms that they have undertaken, which were not very popular at one point in time, but they have yielded results in some form or the other over the years, and now I think we are sort of enjoying the fruits of that to some extent.
So we're enjoying the fruits of that to some extent, but even as we speak, there are more policy measures being put into place. I want to talk to you, Madan, a bit about the whole manufacturing story. India has always been a service sector-led economy. Can manufacturing actually fire up? We're talking now, and there was a report today as well, that India could be the mirror image of where China was when manufacturing started picking up. And that's the big bet. We've seen some of it fructify under the PLI scheme. But how big is the scope for this, firstly? And secondly, what are the challenges?
Tamanna, I would like to divide this particular issue into two parts. See, one are the headline numbers which I spoke of, which are obviously very impressive. But second, if I'm coming to this area which you're talking of right now in terms of manufacturing, I think for quite some time we have been talking in terms of manufacturing improving its share in our GDP to 25%. Now, unfortunately, what we have seen is that most of the growth which we have seen in the economy has been coming more from the services side, where I think we have probably reached the stage of maturity out there. But when you look at manufacturing, I think that has been a major lacking. So I think the government is trying very hard, but at the end of the day, it is the private sector which has to react and take on these opportunities. So PLI is a good scheme. I think all of us are talking of it. But if you ask a question as to which sectors have actually benefited, I think a large part of that is the electronics, that's the mobile phones which you're talking of. And even there's a large component of imports which are coming in, so it gets slightly fuzzy. So I think this is the missing piece, because when you're talking in terms of equality of income, job creation, I think the manufacturing sector is something which has to fire up. So while there is a lot of scope potential there, which everybody sees, I mean, they're going to get those good GDP growth numbers of maybe 7 to 8% in the next 3-4 years. But the important part will be, how does this percolate to the lowest common denominator? How does the manufacturing sector pick up? And just remember one thing, that even today, a lot of what is done at the bottom of the pyramid has been because of direct government intervention. It's not been a case of saying that people are getting those kind of jobs and you're able to buy your own house, you're able to get your own cooking gas, so on and so forth. Most of it has been provided by the government. And remember another fact, that even today, the government is providing free food to 800 million people, which shows that there are certain weaknesses in the economy which will have to be overcome. And that can only happen in case the private sector fires and we're in a situation where the manufacturing sector does well. So I think that is the biggest challenge. And I think the progress even post-COVID has been very, very tardy on this particular front. So I would say that this is a challenge for the economy. Headline numbers are definitely going to be reached. We will continue to be a good investment option for foreign investors, but we will have to take care of this. And this, I don't think the government can do anything much. It has to be done from the private sector.
Yeah, also some concerns on the fisc over a period of time. If this kind of government support continues unabated, of course it was needed post-COVID, but for how long will be the question. Just one important point I want to take with Madhvi, which is the stated goal of India being a developed nation by 2047. Now this becomes important in the context that we're speaking today, because it's a real tangible kind of a goal, layered by clear indicators of what it means if India is a developed nation. Doable at the current rate of growth, or how much more do we need to speed up?
It's going to be a long run process. I mean, besides we're talking 2047, I don't even know how things would really pan out. The global business cycle will be very different in the next 10 to 20 years. So, I mean, it could be challenging, but, let's hope that it is achievable. Why should we think and start our premise by being negative about it?
No, that's true. But my question is, to what extent do we need to notch up growth very specifically?
So at this point in time, I think
we're growing between 7 to 8%. We're growing between 7 to 8%, hopefully. If we consistently grow, is that enough to reach the developed nations tag by 2047?
So I think that is what the target is. I don't think the immediate run, the policymakers are trying to even overheat the economy or trying to even, fiscally very loose with regard to their behaviors. In fact, I think they're very comfortable with the 6-7% growth that we are at this point in time. Of course, the aim has to be growing beyond 8% on a secular basis for the next 10-15 years to be able to reach that level that you talked about. But I think near term, there is no policy rush. There is no unwanted policy stimulus on a net basis. Of course, there will be targeted benefits that they will talk about, they will probably focus on. But, on net basis, the economy would probably be still on a fiscally sort of a conservative path is what I understand. And to some extent, even on regulatory point of view as well, there'll be a lot of tightening that could happen in the coming years. So I don't think that near term you would see the growth path to be exceeding 6 to 7%. The coming year itself will be very tricky, assuming that you will see a slowdown in the world growth order, and not even a recession. Even a slowdown would lead to India's growth to be somewhere hugging close to 6% or lower. So we will obviously grow with the global cycle over the next 10, 15, 20 years. We'll have to outgrow the world, of course, to the extent that we reach the developed world target. But obviously, the world doesn't move in a linear fashion, nor does our own trajectory. But yes, if we need to probably reach that level, you need to be having a steady growth part of 7 to 8% plus for sure.
Absolutely. And yes, our immediate targets and priorities might be very different. What our version of a developed nation looks like also might be very different considering our factors. I have just about 10 seconds, Madan, very quickly. I'm sorry, I'm almost...
In fact, I would say that reaching the status of a developed economy, I think we should have a situation where the government is not providing free food to 800 million people. It should be to 200 million people. I think that's when the quality of a developed nation would emerge.
All right, important point there. That's all the time we have. Thank you so much, Madan and Madhvi, for speaking with us on this special conversation. We're going to wrap at this point, but a very short break and we're right back. Stay tuned to NDTV Profit.